welcome. You're watching Money 9, India's first multilingual platform for personal finance from TV9 News Network. I'm Sakshi Batra, and on this show, we're going to be discussing all about the AMFI data that has got released. So the mutual fund numbers for the month of June are out, and we'll try to decode that to understand where are investors really putting in their money as far as the mutual fund industry is concerned. Joining in is a very special guest with me on this show. I have Mr. Himanshu Srivastava. He's the Associate Director, Funds Research at Morningstar. Thank you very much, sir, for joining in. It's a pleasure to have you with us on Money 9.
Thank you, Sakshi. It's a pleasure for me to be here today.
Thank you so much. The pleasure is indeed ours. Let's begin by decoding the AMFI data numbers. Well, the net inflow for the mutual fund industry has stood at around 15,320 odd crores, which is great because earlier in the last month we had seen an outflow and there has been a sharp upside over here. When we talk about the net equity inflow, however, there is slight bit of downtick. We'll talk about that as well. So the net equity inflow has actually come at about 5,988 crore rupees for the open-ended equity schemes when you compare it to 10,000 odd crore rupees which was seen in the previous month. The ETF flows are about 3,000 odd crore rupees compared to 5,379 crore rupees, and liquid fund flow which has come in at around 2,078 odd crores. We'll talk about all of these data points and not flood you immediately. Let's talk about first the equity inflow part as well. So help us understand, Mr. Srivastava, this sharp drop in the equity inflow. What do you make of it, and why has there been this kind of a drop?
I think the major reason for the drop is the profit booking. If you see over the last couple of months, the markets have moved up significantly, especially when the second wave of COVID, when it started in March and April, there was a drop in the market. And after that, there have been a relentless upsurge in the market. And that has provided a good profit booking opportunity for investors who have invested in the equity for a long time. They would have found a way to exit at this point in time. That's why there is a fall in the overall equity net equity flows. But at the same time, the positive part is that we have positive flows. If until April there were net outflows for 8 consecutive months, and then till March, but April, May, June, 3 months of consecutive flows or 4 months of consecutive flows does tell you that investors are now gaining more conviction in equities and they are putting their money into it.
Absolutely, got that point. But I also have to ask you, since in the last month of June, we have actually seen the Nifty perhaps trade in a very narrow range of about 300 odd points. And there's been this large consolidation, like you also pointed out. Most experts are saying this is a healthy correction in the kind of the bull run. But if we were to stay around the levels that we are right now, or if we see some major correction of about 3 to 5%, which some of the experts have also been hinting at, looking at the kind of valuations that we have and all the other red flags of market cap to GDP and other factors. If that happens, then how do you see this trend going on in mutual funds?
Right. Investors' behavior is at times, it's very difficult to understand. Everyone is talking about the valuations being high. At the same time, there are expectations that the markets may continue with the same kind of rally that we have seen as of now. We have second wave of COVID-19 that happened, but the markets have sort of didn't react as much as they reacted on the first wave of COVID-19. So there is a resilience within the market, which is something that investors are actually able to gauge. So there are a lot of investors who are trying to stay put, but there are investors who would like to, book profit and, wait for some time with the market correction and coming in at a time when the valuations are better for them. So at the same time, I think the broader what investors need to do is to stay put, and that is what we have learned over the last 1.5 years.
Right.
Market during the COVID times and second wave, first wave, all, and are in a better position now than they were earlier. So I think that is the approach that investors need to take.
Okay, understood that. Now, what we are drawing also comfort from the fact that the SIP is at record high levels. I mean, like if you see the SIP accounts have seen net addition of about 13.67 lakh, taking the total tally to over 4 crore accounts in the month of June 2021. There's an inflow of about 9156 odd crore rupees, which is a record high. Help us understand, will this trend continue? Because if this is sustained, then overall we are happy.
Well, I expect this to sustain. I think this is the time when investors are realizing the importance of staying in the market at all times rather than coming in and waiting for the right time to invest. There is a gradual increase in those kind of investors who actually want to be a the market at significant important points. There was a time when investors used to wait for market correction. They would have waited for market correction the second way, but that didn't happen. And I think that
Yeah.
is the realization that investors are now having, that okay, let's start SIP, let's be invested, because that is an auto investment that also instills a bit of discipline in investing, when you are not, where you are actually availing yourself from the challenges of timing the market, which you will any which will not be able to do. So I think SIP numbers, I believe, will continue to rise going ahead, and that is what we are seeing. And I think investors have learned their lessons, and I think they are moving in the right direction.
Okay, so investors are moving in the right direction, and they are, showing maturity even in the times when markets are consolidating, continuing with their SIPs as well. Also on the retail investors' participation in the last 1.5 years, we've been really talking a lot more about how the participation has increased this whole year. How much do they actually account for these monthly inflows and outflows, to just get a sense of it? The unique investor participation in mutual fund industry has stood at what, about 2.39 crores, which has doubled
Right.
from in the last 4 years. And on an average, if you see, the investors hold about four portfolios. But I wanted to understand, this also includes corporates as well, this whole number of
Right.
2.39 crores. So how much of it is
Right.
the corporate participation? How much of it is actually the retail participation?
Okay. So as of now, I don't have exact number as to how they define. What I can tell you is how the number of retail participation is going up, and it may grow even going ahead. Over the
Okay.
last few years that we have seen, like in 2017, mutual funds, IA ads and all,
Hmm.
they have actually worked towards gaining or imparting a lot of knowledge to investors about mutual funds. What are the importance of mutual fund in their asset allocation and their retirement corpus, how they can generate a good corpus for themselves. I think
Sure.
these have worked well. The other thing that which has worked well is there's a lot of media coverage now. There are a lot of people talking about mutual funds, the importance of having that in your portfolio, and that has actually attracted a lot of investors. Now, when earlier mutual funds were limited to some of the top tier cities, now with these ad campaigns, with media coverage, they have gone to even tier two, tier three cities, where more and more investors are coming and investing in mutual funds now. I think
Yeah.
the trend has started. While we have just it's just the tip of the iceberg, but I think the trend will continue to grow as and when as the people progress, and the kind of maturity that we are seeing among investors in the recent times. When if you look at the trend over the last few years, with whenever there is a market dip, the investors have actually come and invested in that. There's a lot of maturity,
Hmm.
because earlier we are coming from an experience where during the fall in the market, investors used to panic and exit. Now that trend
Yeah.
is no more in existence. With market days, investors are coming and investing. March, April month, we have seen that even in last year we saw that we were getting
Sure.
a lot of flows, and when the market started to rise, when they are started making profits, is when they have started exiting and leaving their investments. So I think with this trend and the lot of maturity among investors, with a lot of knowledge and information available to them, and right knowledge and information, I think they
Sure.
will be making the right decisions going ahead, and we will see better retail participation ahead.
Okay. Also wanted to understand, while we have seen that this is a definitely encouraging trend, that, we've seen the unique investor participation really double in the last 4 years, vis-a-vis when we actually see the direct markets. Of course, there has been a correction of about 40%. To give it that due, in the last 1 year alone, we have added about 1 crore demat accounts. So
Right.
the disparity still exists. How soon do you think this gap can get covered up?
It will take time to get covered up. People are, the direct investing in stocks is something that is investors are fancy about. I think they still need to, when it comes to understanding about mutual funds and how they can, be a part of their portfolio, something still there's still time for investors to gauge that. But we are seeing that trend happening. And the amount of the number of demat account and a mutual fund, I think they are two different things altogether. But from the mutual fund perspective and the long term asset creation perspective, I think mutual funds are the way, and that is something that investors are realizing going ahead. And as they have seen the market has burned their hands, and I think that is where they will be putting their money going ahead. They will gain traction. They will continue to gain traction. But if you are looking at the number at par with the DMAT and the number of mutual fund investments, I think that will take some time to get the gap needs to get covered.
Okay, understood that. Now we've spoken in detail about how the net equity inflows have performed and the reasons behind the drop. Let's also take this discussion forward to the other aspects. I wanted to ask you about the arbitrage funds. The inflows over here also have been surprisingly good. Monthly, I mean, like about 9,000 odd crores this month, which is perhaps the highest ever. So, what kind of interest is really coming in here? Could you explain to us, what is really happening with the arbitrage funds?
I think arbitrage funds, the basic concept of arbitrage funds or the understanding that investors has is when there are volatile times, arbitrage funds are better positioned to capture the volatility, the
Okay.
discrepancies in the market, and then they come and invest in these. And that is also one of the selling proposition of these funds as well. And I think that is where it is working because we have seen volatility in the market. The markets have been moving, but there are times when the markets do fail. So the turbulence is still there, despite a one-way movement. There is a turbulence in the market, and these times are sort of considered as good to invest in arbitrage fund.
Yes.
But surprisingly, if you look at the returns, arbitrage funds have not been, when you compare it with obviously pure equity, they have not given that kind of a return. So
Sure.
arbitrage funds, one cannot be compared with pure equity. At best, you can compare them with some of the debt categories, maybe
Yes.
short term or ultra short, because the returns are sort of at par with them. So investors also need to understand that arbitrage funds doesn't target to capture the upside of the equity. They target to capture the discrepancy between two markets. So
Yes.
they shouldn't invest in these funds with expectation of equity returns. So I think that is
Okay.
one of the things that I would like to convey to investors, that arbitrage funds are a different asset class altogether, and you need to understand them well before you invest in them, because then you will be surprised if you have high expectation from these kind of products.
Yes,
Nonetheless, they are
absolutely.
decent products with relatively lower risk, but at the same time, the expectation of investing in these funds has to be right.
Understood that. So all the investors who are out there, who may actually see the performance vis-a-vis equity, there will be definitely a difference, and there are reasons behind that. And you should definitely study that and see whether your risk profile is, more towards equity. Then you should perhaps go for that one. Also explain to us the difference between what we have seen in the trend in this monthly numbers as far as the liquid inflow is concerned, which has fallen, while the hybrid inflow has actually doubled. So, what has really happened here? What were investors really thinking?
I think on the liquid, you are talking about liquid funds, if I'm not wrong.
Yes,
So on the
yes.
liquid funds, and what has happened is, liquid funds is largely one of the funds which normally business people or corporates tend to invest. Whenever they need money, they redeem their investment from there and they put it in their business, and again park their assets back into these funds when they have excess cash. A
Hmm.
hybrid is completely different. So hybrid are a mix of equity, debt, gold. There are various hybrid categories. Now,
Yeah.
if you look at the performance of broader performance of equity, broader performance of fixed income and gold, they have been sort of good. All the three asset classes have sort of performed well. Equity has
Hmm.
obviously done well in the recent times, gold in the past, and debt is doing well after the crisis that it has witnessed in the last year during April, May, June type of months. So the things have stabilized and their returns have also been improved. I think that is where the attraction for hybrid funds are coming. Hybrid funds offer a good investment asset allocation kind of a tool, wherein you don't really have to do asset allocation all by yourself. You invest in one fund and you get the best of all the three markets, and you are able to capitalize on the market opportunities in the equity, debt, as well as gold if you are investing in say multi-asset kind of a fund. And I think that is where it is. They are gaining a lot of traction because all the markets are doing well. Debt is also performing decently well. Equity is doing well. So they are attracting investors into their fold.
For sure. Understood that point as well. Any other, fine print data that you found interesting in today's data, which caught your eye?
So I think one thing that you look at is credit risk funds. That category has sort of started getting inflows over the last 2 months. In the month of May, also it got inflows. In the month of June, also it got inflows around over 200 crores. Now
Hmm.
that is a change in trend. When
Okay.
we look at credit risk fund, say in last year from March, April, and continuously they have witnessed net outflows, and now they have started getting. So things are stabilizing on the credit side as well. Investors are now
Hmm.
opening up to the kind of risk, obviously in a measured approach. Now we are not seeing those kind of among investors about credit funds, which you used to see earlier. But yeah, they are open up of taking some risk in their portfolio for diversification, and a measured approach I can see in their behavior towards credit fund, where they have started putting money. So that is one of the change in trend that I have witnessed, something that is good. But I think investors should be wary of the risk that these funds carry. Credit risk funds does carry risk, and we have seen that in the past. So the idea should be to understand that risk and invest only if you have the appetite for that risk. If in your
Hmm.
portfolio you need a debt allocation which is largely to support equity investment during downturns and not to expose that portion of the portfolio too much towards market risk or other risks that are there, then credit risk fund should be, you need to look at credit risk fund and get better advice from advisors to invest in that. And that is how the approach should be.
Absolutely understood that. And one last question before I let you go, sir, and that would be about, going forward from here. For all the investors who are looking at this data and getting encouraged that, who are still sitting on the sidelines and wanting to invest in the mutual funds, and take that plunge there, what would you really advise for a person who would want to develop a portfolio of mutual funds today? What's the ideal way to go about it?
So the idea is not to wait. A lot of people are still waiting on the sidelines, thinking that the markets will correct, and you never know when the
Yes.
market will correct. When we were at around say 35,000, when the markets were at 35,000, people were waiting that markets will correct. They are
Yeah.
overvalued. Now we are at around 52,000. Still, people are thinking that it's overvalued. It may be, but the markets are moving up. So the idea is to invest, because you are not investing for a 1 year or 2 year. The idea of investment in equity funds has to be long term, and that long term, I believe, should not be less than 5 years, but ideally should not be less than 7 years.
Got it.
We have seen that in the market cycles have become broader, right? And in 5 years, the investment horizon for equity will keep on increasing. So the idea is, if you have a investment horizon of 7, 8 years, 9 years, then there is no point of waiting, for markets to correct or anything of timing the market. You can start investing with lower amount, and then you can gradually increase your investments. The best way, obviously, is SIP. For the investors who are new investors and wanted to take a plunge into the markets, into the world of investing, then hybrid fund is something that they should look at, because they provide them auto allocation. You have equity, you have debt. Based on your risk appetite, you can select whether to go for conservative allocation or to go for aggressive or dynamic or multi. You have options available. The idea is to choose the right option for you, which becomes
Yeah.
very critical. So rather than
Absolutely.
at what level we are in the markets, that becomes less relevant when you are investing in mutual funds, because the idea behind your investment should be a long-term investing. When you are investing for a long term, then market levels doesn't really matter much.
Okay, so well, at that point in time, let me thank you for the insights that you've shared with us, and on the data you've decoded that very simply for our viewers to understand which way is the money really flowing in, and in case they're still sitting on the sidelines, how should they really be approaching the mutual fund space and their investment journey, all of this as well. Thank you very much, Mr. Srivastava. It's been a pleasure, as is always, having you on board, whether for our articles we take your insights or for our video interaction as well. Hope to have you back on Money 9 soon.
Thank you, Sakshi. Thanks a lot.
Thank you. And with that, we wrap up this edition. Well, the AMFI data is out there for you. More good news than bad for sure. And whatever bad news has been there in terms of the drop in the equity inflows, that may actually reverse over a point in time, because this was a time when we actually saw the markets also consolidating, people taking money off the table, and that is getting actually reflected in this monthly data as well. And with that, we wrap up this edition. Many thanks for tuning in, but do stay logged on to money9.com, our website, to get up all the lowdown on the markets and on personal finance data and any kind of buzz that is there, which will definitely be of use to your wallet. Stay connected with us through all our social media platforms, and also like and subscribe to this YouTube channel, and also hit that bell icon so that you can get notified whenever we add a new video. Thanks for tuning in.